Hey, welcome back. ADM stock has been down for a few reasons lately, which is interesting for a lot of people when it comes to a dividend king paying a 3.5% yield. But I think the market is maybe overlooking some very important things and there is a lot more room to fall, so let's look into them. They offer a complete package of commodity logistics and processing, from procuring and storing the raw materials to transporting and marketing the finished flour, flavors, oils and so on. They also recently developed into higher growth industries such as animal nutrition, special proteins and more. They even have investments in some lab-grown meat projects. I know at least about some for animal consumption. If you know them, you are very likely aware of the bull arguments that became very popular since the pandemic, but I want to give you some counter-arguments that you should take into account if you want to invest in ADM or already do. It's ultimately your decision, of course, you do what you want with your money, but I personally like hearing negative arguments against my investments because it gives perspective and improves my overall research. Not to mention that finding negative articles or videos about this company is surprisingly difficult, even if there is enough to dislike about them that everyone is hopefully aware of. Now, as a commodity company, this cannot have constant profits throughout the cycle. They don't have the pricing power or significant competitive advantages and have to mostly depend on the spot price. Sure, they may be able to do it more efficiently, but when I say efficient, I mean this is a 2 to 4% net profit margin company, so keep that in mind. If oil or flour, for example, drops 50% tomorrow, they can't keep selling it at the current price unless they have all the current and future production contracted at such a level. But they don't, and at least the future production will be affected. Now, I think this is the only big company I've seen play so much with securitization, meaning selling your receivables in advance to get money now. This way, they have a very negative working capital change affecting the operating income and free cash flow, but a huge increase in investing activities. The latter doesn't go into the free cash flow formula, by the way. What it does is really mess up the cash flow, and adjusting it is kind of pointless because this is part of the business model and it has an impact. But still, having the cash flow drop deeply into the negative is an indicator of the company having trouble anyway, maybe just not as much as you would think, but still trouble nonetheless. I think in this case, even if I don't like it that much, the net income will be good enough, but more on that later in the video. What we see during bad times is a significant drop in net income before and after adjustments, and the company selling assets and piling on debt to pay dividends and buybacks. This is terrible when you have to keep paying and increasing that dividend. The buybacks are actually great when the price is affected because they can be used later if they keep them in the treasury, but the dividend is just too much. If they downsize significantly just to stay afloat and get debt to pay the dividend, it's only a matter of time until it doesn't work anymore. Financially, they are in a good position with the current assets covering the current liabilities and enough assets to offset the long-term debt. There is about 22 billion in equity, or 15 after the goodwill, which isn't great for a 30 billion market cap in this industry. Simply put, you basically pay $2 for one worth of assets after you pay the debt. The rest is the company's know-how and relationships, contracts and stuff like that. Still, for agriculture, which isn't some high-growth tech, that's quite a bit to pay. They do a lot of buybacks, and I thought maybe I'd see a lot of treasury stock on the balance sheet ready to be used to buy other companies, which would have been great. However, they cancel the shares to give you a better impression about the company and how committed they are to returning money to you. Anyway, something we have to note is that this balance sheet was the same over a decade ago. This company basically didn't evolve in so much time. No addition to the equity, barely replacing some assets, the cash flow is very similar, nothing significant. You would think that in 2-3 commodity super cycles they would at least add some equity and optimize the business, but basically nothing stuck to the company, and that's a very big issue as you are about to see. What's terrible about this company is actually what attracts most people, the dividend. As a commodity stock, having to pay that close to 1 billion and increase it no matter what, even if the company doesn't make that much in that year, is simply bad. And I get it if they saved or invested the extra cash in good times like today, but they just spend even more than what they make on buybacks and increase the dividend more than average. What happens when the cash flow is negative and they must pay a dividend? Well, see 2015 to 20 when the debt pretty much doubled. And it's not only that, it's also the interest that means less money for the dividend. The war and the pandemic were unironically extremely fortunate events for ADM. If they didn't come, I think this company would have been different today. If you look at it, they were losing money over and over despite an improving macro environment, the dividend was growing and the debt was piling up. None of that was sustainable. Sure, maybe they can do it for 3, 5, 10 more years, but eventually they'll have to cut it unless something happens. They simply can't afford to grow it over and over when they barely invest in development. If the management was smart, they would use the stock to develop the company by buying others much more frequently. And it wouldn't even dilute you since it would add equity, assets and cash flows, winning from the synergies and potential underpayments. And people really like this investment for a mediocre 3% yield, which you can easily beat with much better companies. We saw what happens when a dividend king like Leggett & Platt cuts the dividend. The effect on the stock is terrible, potentially wiping over a decade of dividends. I know the classic dividend investors often don't pay attention to the cash flow, but the market has way too high expectations from a commodity stock which is cyclical by nature. Not to mention how much they rely on the management, which, let's not forget, isn't really the best. I'm not even counting this year's scandal that led to a crash, but even the company's recent history is enough. This is simply not a management team that I would trust, especially after the recent scandal. And trust in this case is very important because, again, if they were smart about it, they would have used the high valuation to buy other companies and develop. They would have been okay in this case, but they just cancel what they buy to grow the EPS and reach the targets. Talking about targets, they see an EPS of 6 to 7 next year with high single-digit growth. What's interesting is the 30 to 40% dividend and capex target as well as 5 billion in buybacks. And you probably guessed by now that by interesting I mean it doesn't make sense. First, in the company's history they only made 5 billion in 2021. When did they come up with the 5 billion target? December 2021. They won't keep the buybacks at 5 billion, of course, especially if the cash flow drops into the negative again, and I wouldn't be surprised to see them say how bad the environment is and how they can do it just because of it. By the way, they see an EPS of 5 to 6 and a bit this year, so if there is any issue in the environment, they fail the targets. Secondly, 30 to 40% earnings payout is simply a lie. As a dividend king and commodity company, it's not their choice. Sure, they can cut the dividend, but again, think about the impact it would have plus the effect on the management's paychecks. A dividend king can't cut the dividend based on the earnings, and a commodity company has very volatile earnings. These two don't go well together, again, in the very long term. So, a very sustainable 30-40% today might be 80-90% tomorrow or an error in bad times. If they paid $1 this year, 3 the next, then 2 and so on, sure, but they can't do that. And look, other than the risk behind the dividend, buybacks and basically the management, this is not a bad company. Exposure to food especially is something that I definitely want, and ADM is actually a reason why I got into companies like Adeco Agro, which are better from any point of view. Direct exposure to food and the overall agro industry is actually hard to get from a good company at a decent price. But a commodity company as a dividend king kind of investment, it's probably the worst you can get. They also depend a lot on corn, and I want to talk a bit about this commodity specifically in the US. I think this is one of the most artificially inflated commodities on the planet. The US gives massive incentives and subsidies to keep this industry alive, and it got to a point where there is too much and it's used inefficiently. This is why in the US you can find corn syrup, starch, flour and so on in too many products, which isn't really the healthiest thing. Also, a very significant issue is that about a third of US corn is used to produce ethanol. This is a high potential biofuel, which is great, but making it from corn is probably the most inefficient way to do it. So you have entire countries worth of land with corn that could have been used for much better things. Not to mention that planting corn over and over is bad for the land in the long term. If it wasn't for the subsidies, you could have maybe seen crop rotation like soybean, then oats, then wheat and so on, or higher margin stuff, or even use the land for something like solar farms. Why I mention this is because this could be a potential long-term risk for ADM, and I think it's only a matter of time until the naturally less and less efficient land that has to be enhanced with expensive fertilizers and pest controls becomes a problem. Replacing this can mean less production, higher raw material prices, and a need to adapt the infrastructure, distribution systems and so on, which costs ADM money. Now let's go through valuation. In a bad environment, I want to stress out that they would very likely lose a lot of money. Again, all the extra cash and even more that they got during the upside went into buybacks at all-time highs, not the company. The downside would easily be something like 15-20 billion, meaning a price like the one from a decade ago and a 40-50% loss. But if they also cut the dividend during that time, this can easily continue to fall. I say 15-20 billion because of the equity in case someone wants to buy them, but don't expect the market to be rational in a bad environment. In this case, the dividend, the interest, debt and so on wouldn't be sustainable, so they might either get even more debt or decide to sell some assets or do a spin-off. In a second scenario, with business improvements and investments, let's say they make around 1.5 billion on average. It's tough, but let's say they are traded at a price to cash flow ratio of 12, which is actually pretty high for a commodity company. Even now they are at something like 9, but that's after the recent crash, so let's give them the benefit of the doubt. That's a market cap of 18 billion, meaning a price of 37.64 for a 30-40% loss. So we get to pretty much the previous scenario, which in probably hundreds of companies analyzed on the channel is a first, and keep in mind that this is pretty optimistic. Sure, they can continue paying a dividend, but if they struggle like this on average, it's just not good for a commodity company. And that would be something like a 5.5% dividend, which again you can get with much better companies like Realty Income. Now, during the upcycle, they can probably make something like 3.5 billion. Again, the peak from 2021 was basically during the perfect environment for a company like this. Rising food prices, cheap fuel, supply chain issues in Ukraine, which are excellent news for ADM, and so on. 5 billion again is very unlikely unless they invest significantly. For a high ratio of 15, which is again optimistic, that's a market cap of 52.5 billion. That's a price of 109.2, meaning something like a 90% profit plus the dividends. For a commodity company, such an optimistic scenario leading to barely a 2x is terrible. You can look into other videos I have about commodities and see the kind of potential they should have. It's okay if bought during the downside, but it's very risky in such an environment because they lose a lot of money. You can't predict how long such an environment can last, and if you get bad times for half a decade, this is probably in very big trouble, especially since the dividend would have to grow. I think there is this wrong idea in the market that this is a safe dividend plus food investment and everything is great. For the average dividend investor that buys no matter what, this is not it. This is a cyclical business, and expecting it to be the same as the normal Coca-Cola, McDonald's or whatever is wrong. These are completely different businesses. ADM depends on commodity prices, which are extremely volatile, especially nowadays. With McDonald's, for example, they have this many stores, next year they open this many, maybe do some cost savings, and you have a base you can grow from in a relatively predictable way. I guarantee you that ADM will not have linear growth because it's impossible with such a company. Who knows what pushes oil prices to 100 per barrel next year while food prices don't follow, and there goes the margin. Unless they invest massively, it's only a matter of time until all that irrational dividend growth and massive buybacks at all-time highs in the detriment of the company will have to be accounted for. You know, by the time you reap the consequences as a shareholder, the current management is probably retired, so it's not an issue for them. The current CEO is like 62. Do you think he'll be in ADM in like 10 years or whenever they fall? Another guy will have to worry and try to save it, kind of similar to politics. Honestly, I see no reason to go for ADM when there are so many better options. I might soon go for ICL for fertilizers, for example, which is something essential for food and the price is actually attractive. Nice cash flow throughout the cycle, good profit margin, good equity, similar to the market cap, better potential and close to a 5% dividend today. I feel like you go for ADM if you don't realize what other options you have. And look, you can see on my channel that commodity stocks are one of my main and actually the first thing that I got into. The market simply has too high expectations from a normal commodity company that's messing itself by being a dividend king. If they paid, let's say, half of the profit at any time, like a majority of commodity stocks, this would have been okay. But having to pay and very importantly increase the dividend no matter what or they crash is a huge and impending issue. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.